All right, thank you, and welcome everybody to this specifically targeted meeting of the Powers Pension Board on today, the 3rd of May 2023. First of all, Rachel, welcome Rachel to this new role, and hello again to Carol. And do we have any apologies for absence?
We've received apologies from Wayne Thomas, employee representative, and John Burton, scheme member representative.
Okay, so therefore we have Nigel, David, Ian and myself, in which case a very warm welcome. Ian, you can see me now. I couldn't get my vision when, or couldn't be seen when I was doing a training session with Ian. So we can move into declarations of interest. Are there any declarations of interest, please? Nope. In which case we can go on to item 3, the minutes of the board meeting held on the 10th of February 2023. And if you're happy, could I ask you to authorise myself to sign the minutes of the meeting? If there are any wordings you're not comfortable with or would need an explanation of, we can make time to do that. So if there's anything on page 3, out please, or 4 or 5 or 6 or 7 or finally or 8 or 9.
Chair, I've just spotted on page 9.
Yes,
down as county councillor.
Yes, indeed. That was the one I was going to point out. I have been credited with the same title in once or twice in the past. I think it's part of the process. I think Carol was explaining last time that the tweaks are made right at the end. I'm really not worthy of being a county councillor, but I'm sure with the change, deletion of the words county councillor and my first name added, if that could be arranged, Rachel and Carol, I'd be grateful. And it does seem, therefore, that with that one change, I can authorise and sign the minutes. Are we comfortable with that?
Yes, Chair.
Yes.
Right, thank you very much indeed. Matters arising, just a couple, well, I've got County Councillor Moore at the end, so just a couple of points. On item 6, refers to the single code of practice from the pension regulator. I've seen nothing yet. The CPR, when I was last in touch with them about a month ago, expected the regulations to be laid in front of Parliament soon, was the word used. I haven't seen anything, Chris. No?
No, I've not seen any or heard anything either. No.
However, on the 18th of May, I am co-hosting a conference for pension board members at which pension regulator is attending. So I will be in a position to get an update, as it were, from the horse's mouth then. If there's nothing in the public domain prior to the 18th of May, I will alert you all to what I've learnt on that day. And the other matter arising in item 14, board membership, we welcome Ian very much through our ranks. We still, however, are left with a vacancy for an employer member. And I think we're also looking for a replacement for Wayne. Any updates at all, Chris? I know it's a tough ask.
No, so far I've been unsuccessful in trying to recruit. I'm hoping to carry out another exercise around our employers in the not too distant future.
Okay.
Try and move this on. Yeah.
Okay. Well, I may sort of follow that up offline with you, Chris, as you know, we've all tried hard, unsuccessfully so far, but we may need to think of flexible approaches, as it were. Okay, well,
Yeah.
thank you for that. So today we're looking at the third and final pillar of the risk register. We have covered administration and we've covered governance, and the recommendations from today will, as with the other two pillars, go to the Pensions and Investment Committee. And certainly at an earlier meeting of the committee, the board received very warm compliments as to the work we do, the deep dives we do into the risk register, very much welcomed by the committee. And it's very pleasing to see how well our dovetailing in with the elected members is. And it's really something we should all be proud of, how we work together with the officers, with the committee and with the board. So it's a very helpful background as we go about our charges, our responsibilities. So just as a brief introduction, I'd say there are two elements to what we do today. One is assessing the existing risks and how they're scored and whether anything needs tweaking in the light of our discussions. And secondly, what we don't see on the risk register. Are there other elements perhaps that could fairly be included in the investment pillar? Could I start off therefore, Chris, just by, as Ian is new to the role, by asking you to give us an introduction on the multicolored matrix, so that we can see the range from the greens to the reds and fully understand how we interpret that before we dive into any individual risk analysis.
Yes, no problem. Would it be helpful if I share my screen for everybody? Would that be easier if it's all in one place?
Yes,
Let's do
please.
that. Okay. So hopefully that should now
Mhm.
have appeared. Okay. So essentially, these are the residual scores for the risks. So the scores that remain attached to risks after the mitigations have been put in place. Bottom left corner is low risk, and highest right corner in the pink is the highest risk. So from this color chart, you can see those that are in the green are identified as low risk. Those are orange are more medium risk, red are pretty high risk, and pink are those which we really want to try and avoid if we can. We've got a few that sit in greens and in the orange areas, basically. So medium to low risks after their mitigations are in place. None in the red or pink, which is pleasing, based on the current scores awarded to the risks. So hopefully that's, it shouldn't be that unfamiliar, but it's only something I've introduced fairly recently. So hopefully it does help.
Yes.
A nice visual aid in terms of whether we think the risks sit after mitigation.
Yes, so there's some important principles there, Chris, thanks. I mean, it always focuses the mind when one sees the word catastrophic as an impact. And it's sort of up intake of breath. But it is there. I mean, in other places, we have had the catastrophic in place, but importantly, that was pre-mitigation. And so it's perhaps helpful to think of that as a starting point, that if there were no mitigation, we really could be in serious bother. And the fact that there are no pinks or reds after mitigation is really what we're looking at. We're looking at the practicalities rather than the theory, but we do have to kick off with a theory as to see where the journey we've made from the potential catastrophic impact of a number of different factors to where we are left after the mitigations in place. Okay, so thank you very much for that background. as we go through the deep dive now, again, I could ask, if we think outside the box, are there any risks that are not actually reflected on the investment pillar as it is set out today? So with that in mind, we go on to investment 0001 on page 2. And obviously that was identified at the outset of the setting up of the risk register formally. And this is where assets fail to deliver returns in line with the anticipated returns. And the anticipated returns are really as reflected in the outcome of triennial evaluations and the strategic asset allocation. And there is the consequence set out there. What if they're not properly managed or risk in place? What's the impact? Well, the employer contributions go up. So it's obviously an important one. It has an inherent risk of 6 and a residual risk of 4. And Chris, if you could perhaps just put us all in the picture as to what the scale is of the numbers here.
I think it's 12 is the top share. So it sits firmly in the middle of the risk spectrum. So I guess the question we really need to consider is that, does that feel appropriate? And just one other thing I want to point out as well, just you might have noticed the latest risk reviews column. It has a date of 2020 in the latest risk reviews. That's actually an error. I've spoken to the risk report team, risk register team about this, and it's actually picking up the date of the first review, not the last review for some reason. Right. So they are aware of it. So you have to ignore those dates, I'm afraid, because they are regularly reviewed. Just wanted to point that out before it was spotted. So yeah, this is to do with investment returns and the potential impact on employer contribution rates. And I guess it depends who you ask what the risk is, really. If you ask an employer, they'd probably award this a really high risk because they don't want to see their employer contribution rates increase as a result of a lower than expected return on investments. Whereas if you ask the pension fund, it might be seen from a different lens. So when the risk register was set up back in 2016, this one was awarded a middle of the road score, 6, and the mitigations about being prudent, taking a prudent approach to the valuation, brought that score down to 4. Now, one thing just to add, I think if anything, the prudence has increased. We've actually pulled in some of the prudence to actually make the probability of funding success even higher than it was when this was set out. It's now at nearly 80%, where it was probably closer to 70% when this risk was identified in 2016. So the funds have probably taken an even more prudent approach than it was back then, primarily because of the increase in funding level we've seen since then as well. So I guess the question is, how does it feel in terms of the risk to the employers for their contribution rates to go up? Does 6 feel right? And does the residual feel right at 4?
But before I open that specific question up to everyone, could I just clarify 2 things? We can, if required, use odd numbers, can't we? Is that true or not?
A pass. Yes, I can. Because see, one is 9 there, for example. So it looks so we can use odd numbers. Yeah. Yeah.
Okay. I mentioned that in terms of your comments about residual risk, because you're absolutely right that the level of prudence has increased since 2016. So it may be when we look at the residual, colleagues may be asking the question, should it be lower than 4? However, the inherent bit is where I get turned back to the unmitigated analysis of catastrophic, because I think we just need to be mindful. There's no harm in having an inherent risk which is equivalent to catastrophic if the mitigations are well and truly in place.
Yes.
So having said that, could I invite comments firstly on the inherent score, before we look at the residual score. Would anybody would like to make a start on that one?
Perhaps I could just add something, Chair, if that's okay.
Please, yeah.
Investment return and discount rate that the actuary applies is probably one of the biggest levers that they have when it comes to setting contribution rates and whatnot. So investment return is pretty significant and pretty important when it comes to setting employee contribution rates. So for me, obviously, so up to you to decide. It feels a little bit low. I think 6 could probably push up a little bit. Was my comment.
Thanks, Graham.
Yes, thank you, Chair. I was just going back to the point around can odd and even scores be established. The way in which it works around the matrix is that each of those, the likelihood, which is the column, I suppose, if Chris, if you went back up to the actual table, the column on the left, you score them 1, 2, 3, 4, 5. So 1 is rare, 2 unlikely, and then the same for insignificant, minor, moderate, and then it's a case of whichever box you meet, it's a multiplication. So 2 times 2 is 4. So the maximum would be 5 by 5, which is 25, whereas the lowest would be 1 by 1 multiplied by 1, I guess. Yeah. So that's how so they're not just scores that we can sort of lower by 1. It has to fall within that range. Okay. So how likely is it to happen, and what's the impact, basically? Yeah.
Okay. Thanks, Greg.
Okay, so there's a slight conflict there between how they relate, isn't it? I think so.
Well, I guess we need to be grading them on these 1 to 5s here, then potentially, Chair. So is it likely and moderate? Would be a 4 by 3. Likely and minor impact is a 4 by 2, for example. So, I mean, one approach we could take, I guess, is if he feels that the inherent risk should be slightly higher, I could go away and consider how best to reflect that in terms of where it sits in the table. So do I think it's more than likely to happen? Well, potentially so, but what's the impact? It could be minor, and that could give us an 8, for example.
Yeah.
So if that's an approach that you wanted to take today, I could then feed that back into the table and come back with a revised register for you to take away.
Yeah. Well, thanks very much for pointing out those technicalities, Graham. That's very helpful. And I think, Chris, your suggested process equally would be helpful. So if we could just focus on whether we think the inherent is undercooked. Any thoughts, David?
Yeah, Jared, I think, Jared, it feels slightly low to me. Just slightly. I wouldn't say hugely low, but it just feels slightly low. And I think the point that you made earlier on, it depends who is looking at this. The employer will have a different view about this to the fund. But the other key point is, as with all the other risks that we've got in the register, they're all interrelated. So to deal with this, you need an effective investment strategy. I know that's part of the mitigation and so on and so forth, but even so, I mean, we are, undoubtedly in some uncertain times. It just feels a little low to me, that's all. And if we can go for odd numbers, which I thought we probably could, then, Chris, you'll go away and have a look at it, but it just feels maybe nudging it up a little would be appropriate.
Okay.
Any other comments in that direction? Nigel, anything from your perspective? No. Okay. Any other contributions? I agree with David. In my view, it is low, lower than I was expecting. And as David rightly says, there's so much interrelationship between these different risks. So I think we need a consistency of approach across the board. So if as suggested, Chris, you could perhaps take that away, and
Yes,
it may become an 8, it may become
8
a
or a
10.
9, or a 9 or
Or
10 even, yeah.
9, yeah, I think that's the sort of range we're looking at, colleagues.
Apologies, Chair. It took me an age to get onto the right screen, so I could unmute myself to
All right.
Yeah, I'm supportive of David's suggestion as well, and there's an 8 or 9. I'll leave Chris make the final call on that from my perspective.
Yeah, okay, that's fine. So let's move on to the residual, and it's almost inevitable, really. The first deep discussion we have will, as it were, set the tone for the rest that follow in several cases. So the question is, in terms of residual, I think we all recognise the opportunities taken in this latest triennial evaluation to be more prudent. And so the question is, are we content with a 4 as residual, or is the scope to marginally tweak that down, as that seems to be the overall feeling? Any comments on that?
Perhaps I can just add a chair. Sorry, I'm struggling to put my hand up for, using Zoom. So I'll have to do it with my real hand, if that's okay. Just in terms of the process behind this, we have regular funding updates from the actuary as well.
Yeah.
We do have regular strategy reviews with the investment consultant. And as I say, we have pulled in the prudence. So my view is that either it stays the same, or the trend would be, as you say, perhaps nudge it down slightly, if at all. I'm pretty confident with the mitigations we have in place to keep an eye on this one.
Yes, I haven't detected any desire or suggestions that it should be increased.
No.
So I think from what contributions so far, we're probably talking of a 4 or a 3, but it's certainly one or t'other.
Yeah, okay.
Yeah, I see a few nodding there. I can't see all faces, unfortunately, but I do see some nods. Is there any objection to leaving it at a 4? Because if it's a scale of 12, or is it 12 or 25? What's the maximum here? We couldn't exceed
25, yeah.
25,
25.
it's
Yeah.
where it's almost certainly going to happen, and
Yeah.
it'd have a catastrophic effect. Would
Yeah,
result in
so
that.
we're well away from that. Thanks very much for that, Graham. So leave it at a 4, or perhaps consider a 3. Any thoughts?
My view is I think it should probably remain in the orange category, because it can have an impact on the employers, which could be, depending on the scale and size of the employer, fairly large to them. So although it's I'll leave that one over to board.
Everybody happy with it remaining a 4? Anybody feel strongly it could be tweaked down? You're happy with a 4?
Yeah.
Okay, lovely. Thanks for that. So we can move on to verse 2, inappropriate long-term investment strategy with the consequences of failing to meet funding objectives. And as David said, in a way that potentially would knock on to risk warning, outcome, increased employer contribution rates. So this time it's an 8 as inherent and a 4 as residual. And I think in many ways these are adjacent pieces of the same jigsaw as investment 1 risk. Any comments on whether the inherent at 8 is okay, or is it really almost a mirror image of the scoring for 1? We've heard about. Sorry,
Chair. I was going to say I think it's quite interlinked with risk 1, especially noting the comments in the final around the regular review. So it feels to me as though it's very similar to 1.
Yeah. Anybody with an alternative view on that?
Graham's just captured what I was going to say, Gerard. So I
Yes,
think they're so interlinked that it would
Yeah.
be a bit perverse if we got them out of kilter. So it
Yeah.
feels that they're
Yeah.
in lockstep to me, Gerard. But Graham's captured what I was going to say. So I
Yeah, excellent. Yeah, thanks, David. Could I just make an observation on the narrative on the right?
You beat me to it, Chair. I was waiting for a gap. I was waiting for a gap to be able to get in there to say that needs updating. Yeah, I need to update the commentary.
Right, well, okay, well, yes, I'll give you that one.
Thank you.
Yes, indeed. I think one of the important things is for the interested public that the narratives are very much seen in principle to be as up to date as realistically they can be.
Absolutely. Yeah.
So if we take that away as a general principle to apply throughout this, and indeed all pillars, I think it would help it appear to be live and ensure that the board and the committee are keeping their eye on the ball.
Yep. Absolutely.
Okay, lovely. Thank you. So I think we seem to be consensus there. So if we move into risk 3, active investment manager underperformance relative to the benchmark. So this in a way is a more micro analysis, as it's relating down to an individual active investment manager, and inherent risk 4, residual risk 2, and obviously it's not a macro dimension, so the inherent risk I suggest would be lower, and it would really be a case of the traditional assessments by the committee of the performance of individual asset managers. However, the dimension here to make things more complex is the performance of assets that are pools.
Yeah.
And I suggest we do have a look as part of this exercise at the controls in place, both for those assets that remain in the name of Powys and not under the pool, and the pool and their processes for monitoring. So Chris, if you could kick us off on your descriptions of processes in place to review the performance.
Yeah. My first comment was going to be, thank you, Chair, was that this is probably just needs a slight tweak to reflect the fact that most of these active assets are now pooled.
Yes.
So we are heavily reliant on the pool doing their responsibility when it comes to monitoring active management, which is done by either Link, who as the pool operator manage one of the sub-funds, or Russell Investments, who work on behalf of Link as their investment consultant to monitor and manage the other sub-funds.
Yeah.
So there's regular reviews. I attend a quarterly update meeting held by Link and Russell Investments, just to review performance. The performance information is shared to the Joint Governance Committee and presented at the public meetings. And on top of that, we have Hymans Robertson, who sit as the pool oversight advisor at the pool level as well. So there's quite a lot of processes that go in place behind the scenes, and in fact in the public eye as well, when it comes to monitoring performance. And I think I'm fairly comfortable that if a change needs to be made, then a change will be made. And we've had that assurance from Russell Investments that if a manager's not performing, they'll question them why and be willing to make the changes of managers as required, if required. So from my point of view, I'm pretty comfortable with the process in place. And as the scores probably feel about right, I would say, from my point of view.
Yeah, and I think to add to those opportunities in place to review performance, of course, we can add our own pension and investment committee
Yes,
as they do still having interest at that level as well as this overall.
absolutely. Yeah.
Macro and micro. One observation I have, again, on the right-hand side, is whether we all feel comfortable with this very brief comment, approach to comments on the right-hand side, or is there a place either here or elsewhere of sort of setting out the detail, for example, Chris, that you just described, the various processes in place, the multi-layered processes in place. Is it overcomplicating things if we aspire to set out those mitigating processes in the comments side, or is it better to keep it to a simple and a summary analysis as is the current style? My gut feel as a previous auditor many decades ago is that somewhere along the way there should be set out for such a key dimension as 1, 2, and 3 what the controls are in place. Pension regulator is very much focused on internal controls, and I think this is a really good example of where those multi-layered internal controls are operating. So just first, on that principle, do you think the review summary, which is very concise, sufficient here, or would we make it too unwieldy if we set out in more detail precisely what the internal controls were? If those internal controls may be better off in another document, so be it. But I'm just throwing those observations up for ideas for reactions. Anybody want to?
I think I could find a middle ground, Chair, to be honest, that provides enough detail in a summary format. I think it'd certainly make this part of the meeting easier if those reviewing the register could see the controls are in place, and certainly for the public who are able to see this document as well, give them some comfort. So I'm quite happy to expand on it and find a middle ground that works.
Yeah. Well, thanks, Chris. That's ideal. Any comments therefore on the scoring as shown, 4 inherent, 2 residual? Anybody uncomfortable with those?
No comments on the scores. I was just going to comment really on the there's a controls and actions section, isn't there, just below each risk?
Yeah.
Is that where the detail goes into? Because reading some of that commentary, particularly the one for for risk 3 and risk 4, really it does go into a little more detail there. So is it the way in which it's reported on JCAD?
I think it can be tidied up essentially, Graham. Yeah, I think there was some of the duplication things have come across from when the it was brought across in the fund's separate risk register. I think it was a copy and paste from Excel, for example. So I think there's some work to be done, but it can certainly capture some of the commentary within those controls and actions, because that's exactly what they are.
Yeah.
And that might be a better place to reflect them.
Yeah, that does. Thanks, Graham. That does sound very sensible. And it shouldn't overcomplicate it. It could keep the right-hand side, the basic summary, precise and concise, yet at the same time, through using the controls and actions facility, it can be more specific.
I think what the right-hand column is doing is actually a summary of the review. So when these periodically appear for review, this is the opportunity to say, based on the controls and actions, there was a quarterly review held in June 2020 or something like that. So it's actually commentary for the review, and the controls and actions is probably where we're looking for the summary, I think.
Yeah, that does make sense on reflection. Yeah, that's good. That's really good. So we're content with the 4 for the inherent and the 2 for the residual. Yep. by the look of it. At this stage, can I just ask Ian how it's going from your viewpoint? Are we losing you, or are we you getting an idea of what the function of the board is? Any observations?
Yeah, I'm definitely picking up a few bits, but it's difficult to know with the ratings, particularly. I think getting more
Yeah.
idea on what they are and why they are.
Yeah, it's as I say, it's a challenging role being a board member, and really grateful for you volunteering. It is a steep learning curve, but it's just incremental progression, really. The regulator hopes board members can hit the ground running. That sounds great in theory, but in practice, it's not particularly realistic. So, by sitting in and just being part of this initial discussion, you'll get to learn the ropes pretty quickly anyway, I'd suggest.
Yeah.
Thank you for that input, Ian. So we can move on to risk 4, to permit deficits to be eliminated over a recovery period rather than immediately. And inherent 4, residual 2. Chris, do you want to kick off on this?
Yep, can do. Thanks, Chair. So this is just a brief summary. Is where an employer is not 100% funded at a triennial evaluation, then a plan is put in place to recover that deficit over time. At the last valuation conducted in 2022, the norm, the fund has an overall recovery period of now 13 years. So it's been pulled in quite considerably over time, and that's just reflecting the improved funding position that the fund finds itself in and the employers within the fund. So it's relating to this paying off of any deficit for those employers that aren't 100% funded, essentially. So we work with the actuary to establish the funding levels, and for those who are maybe less well funded than others, there might be some scope to increase the funding, the deficit recovery period, because simply it might become unaffordable if you're asking for too much in terms of deficit contributions. So it's essentially saying we've identified that some employers are in deficit. Have we got a plan in place to pay off that deficit? Well, yes, we have. It's in the funding strategy statement, and we do work with the actuary at each triennial evaluation every 3 years to establish the recovery period for each of our employers. So for me, the fact that the fund is nearly 100% funded now, and the employers within it are, if not already there, are approaching it, I'm fairly comfortable with the approach that the fund takes and the actual scores. But over to board now for any comments, really.
Any comments, colleagues?
None from me, Chair.
Likewise, none for me. I think Chris has captured that really well.
Yeah, thank you. One possible suggestion to make it clear to a reader that this is very much live and contemporary is a scope within here to make reference to the triennial valuation 2022.
Yes, okay.
Obviously, the last risk reviews dates will change anyway.
Yes.
But we've got the assurances as reflected in the actuaries signed off triennial evaluation.
Yeah.
And I think, I say, I can just ensure any reader would realise it's bang up to date.
Yeah, that's fair comment, Chair.
And the other controls and actions could potentially develop the theory, the principle of recovery periods are restricted. And the fact that if ours is now 13, there's a lot more prudence in there.
Yeah.
Than required by the regulations.
Yes. Yeah.
So any references to triennial evaluation here, I think, and the date of the triennial evaluation would be a big help, maybe.
Yep, I'll include that. Yeah.
Thank you. So we can move on to investment risk 5, permitting contribution rate changes to be introduced by annual steps rather than immediately introduces a risk that actually restores solvency is insufficient between successive measurements. And there are a couple of specific comments underneath. Inherent risk 6, residual 4. Anything from you on this, Chris?
Yes, I think this needs to be updated to reflect the fact that it can work in both ways. So I think probably when this risk was identified back in 2016, it was because there was a plan in place to help employers step up to the ultimate contribution rate that they actually determined.
Yes.
And it can work the other way, as we've seen at this valuation, where employers are having a reduction in contribution rates rather than award the whole reduction in the first year. Some employers are stepping down to it. So I think it needs to be a reflection in this risk to say, look, we know that employers can be in deficit and we can build a plan for them to step up to a rate. But we also need to make sure that if we are offering a step down, that if things change in the interim in both directions, we need to be on top of it and be able to adjust things accordingly and plan accordingly. So I think that's why that's in there, and the fact that if an employer is ultimately stepping up to contribution rate, then there's a risk that things might change. If a stepping period 6 years, for example, that's over 2 valuation periods. If halfway through after 3 years things have changed drastically, decrease, for example. So it's a case of helping managing cash flows for employers and keeping a stable contribution rate for our employers where possible. So in terms of scores, again, I think they feel pretty good from my perspective, but that's just a bit of background as to what this actually means, stepping to an ultimate contribution rate over time.
Right, okay. Thanks. And any observations on that, please?
Yeah, Chair, if I can just add, I mean, there's a key control here and an additional mitigation, because ultimately it's got to be signed off, isn't it? I mean, it's not in the gift of an employer. So the backstop is that for it to go to the government actuaries department and be signed off, it's got to be signed off, isn't it? So there is a really good control there, I think, and therefore I think a 6 and a 4 feels about right to me. But I can understand that stepping it up is very attractive for an employer facing budget cuts, but stepping down also has some potential risks as well in the longer term.
I think that's a great point, David. I think the fact that the actuary has to sign off any of these approaches is an ultimate significant control. Yeah. Oh,
absolutely. Yeah. No, thanks, David. That's a profound point.
I just draw on the discussions I had when I was at Powys and having quite long discussions about the stepping up process. But at the end of the day, the actuary was content, so it was signed off. But it is a mechanism that some employers don't realise they have.
Well, one of the thoughts I'd had about possible omissions from the register is probably more relevant here than elsewhere. So I'll throw it in, although it may want to be treated separately. One thing that's emerged recently is the issue of refunds to exiting employers. Whereas in previous years, it was usually a case of, well, how does a deficit get met? Yeah. And now, of course, with a change of regulation and what was a good financial performance leading into the 22 triennial evaluation, various exiting employers have been in credit. And so that there's two things about that. There's a sort of cash flow risk. And cash flow is something that perhaps could come in on this risk register in its own right anyway.
Yes. And did we not discuss cash flow on one of the other registers? I might just have to check up on that, Chair, to see if we've already picked it up elsewhere, but whether it should actually be on this one.
It should be somewhere.
Yeah. I think it
and
might be, yeah, okay.
yeah, if you could, yes, I should have researched that beforehand. I didn't, Chris, sorry, but
That's okay.
it obviously one or two particular high-profile authorities had been potentially on the hook for a lot of repayments to exiting authorities, and obviously the legal aspects of that were looked
Yep.
into, and changing regulations to help manage the process, and in by doing that, help reducing the potential liability, giving local decisions on it. But it could have meant that, for example, if a fund was cash flow negative and it suddenly had some exiting employers with big refunds,
Absolutely.
could have hit the cash flow, could have meant some investments had to be redeemed well ahead of anticipated schedule.
That's a fair comment and a perfectly legitimate risk. I think that one. Yeah, I'll think on that one. Yeah.
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 Okay. Thanks, Chris. But the general feeling is that a 6 and a 4 seem about right. Yep. Okay. So thank you for that. I'm just checking the time. 10 to 4. And again, to what extent the controls and actions need another comment made as to the current situation is something we could think about, Chris.
Yeah.
Just perhaps another line to reflect the issue of it exiting employers. Because it's two-way now. It used to be just one way, didn't it, really?
Yes.
Okay. So let's move on to 6. AM price inflation significantly more than anticipated. Well, we've been there. We are there now, if not probably. I've made a note somewhere about issue of LDI strategy and corporate factor, which is only marginally impacted on LGPS, but certainly the corporate sector was in a bad way and had to take some pretty meaningful corrective action in the last 12 months. So I just paint that as a background to investment risk 6. Now this is a 9 inherent with a 4 residual, and so there are different sides to the coin in a way, because it could make a change in discount rates on the one hand. On the other hand, it could increase considerably payments to scheme members in pension, or for active members in terms of building up liabilities. So it's a little bit more complex than on first reading. Any thoughts, Chris?
Yeah, I have got one additional thought actually, and it's something that actually came up as part of this valuation. Because obviously we're in a high inflationary environment at the minute.
Yeah. So
an approach that the actuary suggests we take at this valuation is that we build in the contingency for the short-term inflation, because it is expected that inflation will come back down again, by essentially building it into the valuation. So adding on, I think it was 5% in terms of the current inflationary environment over the short term to help manage it. So that could be seen as an extra control, perhaps, is that we have the opportunity at each valuation to consider inflation and work with the actuary on how best to manage any potential high inflation environments.
So by the sound of it, I'm sure we'd all agree it is an extra control. And flexibility as well.
Yeah.
That nods there. So I say we have this 9 odd number.
Must be a 3 by 3, obviously.
Yes.
Done the maths.
Yeah, you can't say that for a 7, you know, but, or an 11 or a 13. But there we go. Are we any observations on the 9 and 4 scoring?
To me, Chair, it feels appropriate in terms of the impact on liabilities, which is one of the things that
Yeah.
helps raise a deficit. As liabilities increase, it puts a strain on employer cash flows and whatnot in terms of contribution rates. So I think it
Yeah.
feels okay. And the fact that I've introduced that additional control, it feels again okay to bring it down to a 4 from my perspective. But over to board.
Yeah.
Any comments on Chris's comments?
I think that feels about right to me, Chair. I mean, everybody's must be focused on this at a particular moment in time.
Yeah.
You can only go back a few years. You never thought we'd see the impact.
Yeah. Absolutely.
I think now. So, what Chris has added, to my understanding, is there's a depth of approach around this, and I particularly like that discussion with the actuary around that. That sounds quite creative to me. The budget process might not like it, but I'm pleased to hear that is a potential mitigation around this.
And as I think we all agreed, it justifies inclusion as an extra control in the narrative at the bottom.
Yeah.
Yeah. Okay. Thank you. So on to 007. Insolvency of an investment manager investing pension fund assets, a 9 and a 6. I know we have had a discussion on this in the past as a board, and there are certain controls in place which are national, but it's really a case of what we can do locally, particularly in terms of monitoring. And I think for us, we have to look to the pool in many ways for the first level of monitoring on this. So Chris, again, I appreciate your perspective on what we have set out in front of us here for risk 7.
Okay, thanks, Chair. I think this one closely aligns to the monitoring of the active managers risk that we spoke of earlier on, and the controls that the pool has in place with regards to monitoring Hyman's, Russell Investments, for example, quarterly monitoring to Joint Governance Committee down to local level as well. So for me, it feels as though it should probably be aligned with the earlier risk, which I think was an 8. Did we say we were going to push that up? I can't remember, but it feels as though the score should be the same. I think we should reflect it the same way, because it is a pool control with monitoring locally.
Yeah.
So I think we're relying on what the pool does to monitor this, which then feeds down to our committee. So that's my view. I think it should probably reflect the active manager risk that we saw earlier on.
Yes. So investment risks 1 and 2 are ending up at an inherent of either an 8 or a 9, and
Yes.
a residual of 4. This is slightly out of kilter with a 9 and a residual of 6.
Yeah.
Can we justify, as it were, making the residual of 4 to be consistent, or is there sufficient that we can't control at an individual investment manager level that requires this to remain at a 6?
I think that's a fair point, Chair, because we have seen some difficulties between a particular link fund,
Yeah.
which probably adds another layer of risk to it, actually. So yeah, thinking that, I think 6 probably does feel a little bit better for this one.
I've got a thought on this, but I'll invite colleagues first.
Yeah, I think from my point of view, I mean, it keeps coming back to the role of the pooled arrangements, doesn't it? I mean, that adds another level of assurance. But I'm a little bit out of touch about whether or not many investment managers are facing any difficulties. I can't say, but I mean, from my point of view, it sort of feels about right, but there is good, strong mitigation through the pool.
Yes. The point I was going to make is really already contained in the potential consequence, because as we've witnessed from one particular fund in the southeast of England who had Woodford Investments, as described in the potential consequence, reputational damage. Well, that fund really has suffered reputational damage as a result of Woodford, and in a way that, in my mind, I think consistent with what David's suggesting, maybe there is an additional element of risk, the reputational risk of an individual manager compared with market movements. You can't control the market movements, but if it's an individual manager that gets into deep problems, what has it said for the due diligence process?
Yeah.
Earlier on, has something been missed out? So I can see the justified enhancement to the scores of 4 on risks 1 and 2 that we get to in terms of risk 7. Does that make sense?
Yeah, I think there's an added layer of risk, which is probably reflected in the residual score of 6 here, to be honest, on reflection. Yeah.
So I think we're content with the scores. We perhaps could have a slight addition to the controls and actions to reflect WPP and the processes we've just gone through earlier.
Yeah.
And so just an extra line or so in the controls and actions, is that? I think that would suffice.
Yeah.
Yep. Okay, a few nods. Okay, thank you. So we move on to page 4, and there are some other comments there, aren't there, already? And again, the reference there to February 2017 was one I was referring to earlier. But again, we could perhaps get that up, an update now to refer to the pool.
Yes.
Okay. And lo and behold, here we go. Investment 8 is the pooling of pension fund assets with other LGPS pension funds. A 9 and a 6. Again, a few details set out under the control and actions. And I think it may be worth looking at those now. The due diligence, clearly important. And the structuring of the pooling vehicles.
Yeah.
And somewhere in there, it may help perhaps if there was some reference to taxation efficiency. I don't know, take that one away because maybe it's not.
I think this one needs bringing up to date. This is out of date now. So I think perhaps if you're comfortable, you leave this one with me and I update it. And then when I share the revised scores, I share an updated version of this one, if that's okay. It was obviously written at the time that pooling was just
in its infancy. Yeah.
And we're obviously a long way on from that now.
Because there is an adjacent piece of the jigsaw, really. And as I mentioned to Chris and Jane and committee chair, the department are looking at the potential merging of pools. And I was invited to offer my comments as a number of other people were. And any time now we should be getting the IP magazine for May, which will have comments from various people about their thoughts on the implications. I've restricted my thoughts entirely to governance rather than investment consequences or cost savings on investment management costs. But I've looked at the governance side but it is potentially another risk because DLUX seem to be wanting more and more and more.
Yeah.
From my narrower viewpoints as a board member rather than a committee member, we've already undertaken a massive input of skill time from Section 151's monitoring officer, pension officers, to get to where we are with a governance structure that works and seems to work well for Wales, for the 8 funds, in that everybody has a vote. Everybody is represented on the committee. And if there was a forced merger of pools, one couldn't guarantee the governance arrangements would be as robust as they are now. And in fact, we could potentially lose votes if we were deemed to be, WPP was deemed to be a customer of another pool. And there's another pool that's in the same position of vulnerability, in my humble opinion, as WPP. So I don't know, Chris, whether that justifies extending investment risk 8 or whether it could be amending investment risk 8, or is it worth making reference to it at this review, or do we simply await developments? I'm very much open to comments. David's hands up. So
Yeah, I was just going to make the movement to bigger units and more concentrated investment decisions in fewer hands is also a risk, I think. And I mean, it was one of the issues that I remember having some concerns about the pooling arrangements across Wales, because local funds could not make their own decisions about the investments to align with their own funding and requirements and profiles. So one of the risks that I feel around this is actually we're going to end up potentially with a bigger risk being created through pooling stuff into one set of hands. I mean, Gerard, you probably know you would know far more than I around the mitigations that would happen, but I've been listening to what's been going on around this, Gerard. It does concern me on a number of levels. So I think, the risk, we've got it down as a 9, I think, haven't we, at the moment, Chris, on here?
Yes.
I'm almost tempted to feel it's a bit higher than that, because I can see lots of issues with this, and we might as well just say let's have a national pension scheme for local government. So I find some concerns.
Yeah, and if we were to be forced down that route, it wouldn't take long for the government to consider, well, let's grab the assets. Why? It's the only funded scheme. Why does it need to be? It's an anomaly with the rest of the public sector. So I think it's a deck of cards that potentially could collapse. Now, I'm not a doom monger in any way, but I think the tide could be flowing in the wrong direction, and it could lead to some radical changes. And it is the local government pension scheme. And I think the way things are going, the local element of it could be severely damaged.
Can I add a couple of comments, Chair?
Yeah.
If that's okay. I think we're looking at a couple of things here. Investment 08 is the risk around how we pool assets.
Yeah.
I think what we're talking about is potentially a change in legislation as well, as what you and David have moved on to.
Yeah.
And that's one we potentially have less risk, less control around.
Yeah. Yeah.
We have more control around how we pool assets.
Yeah.
Where we're told to pool them is something different, isn't it? Which is legislation. So whether we want to separate that out, because with this, regards to the second one, I'm not sure I can add anything to that yet. Because we don't know, do we?
We don't. However, there's part of me that says, well, what I've been saying is probably more of a governance risk than an investment risk, or it could be seen as both.
Yeah, there's an overlap, isn't there?
Because it took as I said earlier, it took a huge input of time to set up the structures that work for each individual pool.
Oh, absolutely. Yeah.
And what additional resources, not least of which people's time would be required if there was to be a merger of pools, or to destroy some pools and making the underlying funds, say, customers of another pool. But I say I don't want to send hairs running, but certainly DLUC have been sounding the warning bell that they are looking for greater savings, greater efficiencies. Any thoughts as to whether we shouldn't worry about it for now? You know, I don't mind if people think now is not the time. I'm quite happy to hear that from you. But any observations welcome.
Whether I could wrap that risk up in terms of pooling in general. I guess I'm at the place where I think we maybe just need to sit and watch where that particular risk goes at this point in time. But it could be wrapped up in terms of the risk around pooling assets, because it would be the same thing. We'd just be moving elsewhere potentially if that was the direction of travel. I'm just not sure that we're at that place yet.
Yeah, no, I hear you, Chris, on that.
I think there's some more work to be done on investment risk 8. I think it's out of date. I think I need to bring it up to date, and perhaps within that I could build in concerns you're talking about. Yeah.
I always sensed that as we were embarking on 3 deep dives, that if there was any one of the 3 that we would not as a board be able to do a checkmate in one move, it would be this. So I really think Chris's suggestion of taking things away, modifying in the light of the views expressed today, and then coming back to the board, it is probably a journey that is well worth the effort because of what is involved, because of the risks and the implications of the risks out there. I think anything to get this pillar as up to date and robust as we can is time well spent, and I'm pretty certain the committee would very much endorse that view.
I think we've got much more experience now with 5 years, 6 years down the road of the risks attached to officer reliance, committee attendance, committee membership, everything. So I think it's well worth updating, that's for sure. And
committee training as well is a key dimension, but that comes in on the next one, really.
Yes.
Okay, so we content with that discussion, so Chris can take it away, bring it up to date, and determine where there's some things we just sort of keep a watching brief on at this stage without going into any explicit detail. It makes sense to me. Okay, thank you. So we can move on to MiFID, item 9, ongoing compliance. It's a strange one, MiFID, because we don't know how well the investment asset industry is undertaking its responsibilities under MiFID, yet they are crucial. Yeah. There is a process in place for asset managers to assess whether their ongoing clients, including pension funds, have got the necessary knowledge and skills and experience to make their decisions. In my view, it was always going to be a light touch by asset managers. They wouldn't want to be throwing away business through being too harsh in their interpretation, in my view. So it's not an exact science, this one. But I think there are 2 dimensions to it. The external dimension, which is the approach of asset managers, which we can't really control. And there is the internal dimension as to how we as a fund do our best to ensure our decision makers, in other words, pension committee members, are up to speed and competent to make decisions in the investment area. Is that a fair summary, Chris?
It is, but perhaps I could just add a bit of background as to what MiFID is for those who might not
All
be as
right, yeah,
familiar with
sorry, yeah,
it.
please go ahead.
Essentially,
Yeah.
And look, it's reflected in the inherent risk score. Actually, it's if we were not MiFID II compliant, then we wouldn't be able to invest in the funds that we're able to. We'd be treated as a retail investor, not an institutional investor, so we wouldn't benefit from the same sort of terms and investment fees essentially. So it would cost us a lot more, and we wouldn't have access to half the types of assets we're able to invest into. So it would limit our investment opportunity, and we wouldn't be able to diversify. It costs us a lot more essentially. So the risk is actually pretty high. What we do internally about that is not reflected very well in the controls and actions. I mean, regular review of MiFID status doesn't tell us anything. But essentially what we do is we regularly make sure that we meet the criteria to be able to carry on operating as an institutional investor, i.e. accessing all this range of assets that are out there and different type of investment opportunities. We do that through logging, offering training to our committee members, logging training to our committee members, and answering questionnaires from our asset managers when we get them periodically, just to reflect that they are checking that we're doing this, and that our decision makers, as the chair mentioned, have the knowledge and the skills to be able to take those decisions appropriately. So inherent risk is pretty high. If we don't do it, then we won't be able to invest as we want. Our strategy would have to change, and it would be pretty much a bit of a disaster, to be honest. So I think there's a couple of things. Maybe I can flesh out the risk identified, MiFID II ongoing compliance, and I could go into a bit more detail to say what that means. I know it mentions a potential consequence there, but again, I think that can probably be developed a little bit.
Yes, I think it should be really to include at the very least higher investment costs and loss of diversification opportunities.
Yeah, which is one of the things we've been able to benefit from as a fund, is our diversification is quite high actually, so we would lose that. So the inherent risk is the highest one we've come across so far. Probably because it needs to be. Whether that's appropriate, I guess that's a discussion to be had now, but that's the background. We need to make sure we abide by it.
I mean, going back to the matrix on page 1, to me, this is where the word catastrophic really does apply. Yeah,
I would agree. It needs to be up to that end of the scale.
So, whether, dare one say it, whether a 12 is sufficient is a fair question to ask, because reputational risk would be hammered.
It would be huge, yeah.
We'd absolutely get it in the neck if asset managers felt that Powers Committee wasn't up to speed. It would be catastrophic, as well as the reputational risk and the financial implications. So if anybody felt 12 was inadequate, I think we could have a debate about that. Any thoughts as to whether 12 perhaps does fairly represent a summary of what we've just discussed?
If you were saying it was catastrophic, you couldn't get to a 12 using that matrix, because it could only be a 10 or a 15. If I'm reading that right.
You're better with you're quicker with your sons than I am, Ian. Well done.
Yeah, so I guess how likely is it to happen? And we'd have to think about that sort of scale. But the outcome is somewhere in the catastrophic column, I think. Personally. It's just, I guess, then how it was where we see how the likelihood of it happening, I guess.
Yeah,
so 10 or 15. I can see where Ian's coming from. Then it's a 2x5 or a 3x5, and unlikely.
Yes, yeah. I think we can look at that as a sort of binary option, a 2x5 or a 3x5. Any thoughts?
Is it unlikely or possible? I guess. But if we do that, then it actually takes the score down. If we go with unlikely,
it would be a 10. Yeah.
It means it's a 10. Yeah, so it actually goes down.
Yeah.
I actually think it's probably unlikely. because there would be enough forewarning if this were to happen. This wouldn't happen overnight unless we had a change of regulatory environment. But it is undoubtedly catastrophic. I mean, this is where perhaps the system falls down a bit, because if it did happen, it would have a whole domino effect on employers' contribution rates as
Absolutely.
well, and
Yeah.
it would absolutely undermine the fund's viability. But how do you get to, as Ian's mentioned, how do you get to that figure using the matrix? But it would, I agree, it would be absolutely catastrophic. So, but is it likely? I think it's unlikely, because
Agreed.
you would, how can I put it? I think there would be evidence over a period of time that that's the direction that things were going in, and people, you would step in, Chris, to make sure
Yeah.
it didn't happen anyway. So I personally think it's unlikely, but how do you get a catastrophic score saying that?
You make the point, David, about potential change of legislation.
Hmm.
When I see that in two totally different dimensions. There could be legislation by the likes of FCA on the Financial Conduct Authority on asset managers, who could be reviewed to see how they have implemented and are managing MiFID II. So there could be pressure from that direction. On the other hand, we know from managing the risk that within the LGPS, the Good Governance Project is very much focusing on, amongst other things, the training needs of elected members. So I think that will raise, by its nature, will raise the standard, where the standard may at this point in time be weak in one or two funds. Particularly, for example, if after the English elections, some funds may have complete clear out of pensions committee. So I can see, pressures on different parts of the spectrum in different directions. But I, from my reading, I don't think there's been an awful lot of work by the FCA on reviewing how asset managers are managing their ongoing requirements to ensure their investors are up to the curve in terms of their knowledge and skills and experience.
Yeah.
So I know I'm pushing boats in different directions there, but I think the residual, to me, I think is probably about right.
Residual.
The score of a 6.
Yeah.
But
I think so. I'm pretty comfortable we got controls in place,
Yeah.
as David says. That there would be some
Yeah.
indication that we're going to fall down on this one. I think.
yeah,
So.
yeah. The internal audit reports don't cover this aspect, do they?
No, I'll just double check the Wales audit ones, whether they go into this detail. But
Yeah.
certainly not the internal ones. No.
No. In my experience in boards elsewhere, I think it's probably more of a concern from the board's perspective than the committee's perspective, because board members know we have that obligation.
Yeah.
Our statutory obligation individually to ensure our own knowledge and skills are sufficient.
Yeah.
But good governance, as I say, is determined to raise that bar for decision-making committee members without it being absolutely obligatory. But as Chris said, we're a hell of a lot of pressure on to get to the necessary level of competence.
I need to tidy that one up as well. I think to reflect all those things we've discussed.
Yeah.
It's not fleshed out enough at this point in time.
Okay, I'm very conscious of the time.
Yeah, so I was going to say, Chair, so I need to leave at 4:30, I'm afraid. I'm very sorry, everybody.
It's okay. I've gone a bit in depth on some of these. I think we're okay on 7. I don't think we can add anything to the discussion. Is that fair comment? So we can move on to, and again, there are
I've got two.
quite a lot of controls and actions set out below that, which is good because I think these are the importance of emphasis on internal controls. So let's quickly move on to the final one, 11.
Okay.
Yeah, on to 11. Sorry. Increased risk of on-fund employers. A 4 and a 4. The potential failure of participating employer or unsustainable employer contributions.
I don't think it's on the right risk register to start with.
That was that's absolutely right, Chris. That was my view. It's a governance
Yes.
issue. There is a financial risk to remaining employers, accept that. But final comment really from me. Chris and I did discuss whether there could be a fourth pillar, which was just financial, because this is one that, doesn't really fit easily in any of the three, but it's relevant.
It is, but at the last committee meeting, I took the recommendations that the board made on the governance risk register, which actually talked about employer contributions.
Yeah.
And I said I'd like to keep them separate because there was some discussion, if you remember, at the last board meeting about amalgamating some of the risks.
Yeah.
And I actually considered that away from the meeting. I actually took it to the committee. I said, look, I think we should probably keep these separate because they are focusing on individual things.
Yeah.
I think this fits alongside those nicely, actually, on the
government. I agree. I agree.
Risk register. So I think a financial one could be useful. But I think for now, because this is the first deep dive we've done through the three pillars, let's try and keep it to 3 for now. And maybe I could include this on the governance one.
Yeah.
If that's okay.
Yeah. Okay. Right. Thanks ever so much, everybody. I'm conscious of time and other commitments. Again, a very useful deep dive. I'm afraid there will be a bit of work on Chris's shoulders to take away and consider those thoughts. But bearing in mind what's at stake, I'm sure it'll be time well spent. So many thanks. I look forward to seeing you next on June the 22nd, I think. Our next meeting, 12th of June, sorry, 12th of June.
12th.
Yeah.
So many thanks, particularly to Rachel, Carol and Ian, and also other colleagues. I will have a talk with Chris sometime to see what we can do about ensuring we have a full representation on the board. It is a challenge, but thanks very much to you all for your contributions today, and all the best. Take care. Thank you.
Thank you.
Thanks, everyone. See you soon.
Bye.
Thank you.
Cheers.
Thank you, Chair. Thank you all.
Thank you. Thanks, Nigel.